You think you had a bad day? One CEO just lost $2 billion worth of market cap. Investor Beat starts now. Thanks for watching. I'm Chris Hill. Wall Street ending the week on something of a down note. Nearly every stock in the Dow Index finishing in the red today. So let's hope they all get a little rest over the weekend and come back strong on Monday. Joining me in studio, Charly, Travers, and Ron Gross. Guys, our top story, shares of Activision Blizzard hit a 5-year high. The company behind best-selling video games like Call of Duty and World of Warcraft is buying nearly $6 billion worth of shares from majority owner Vivendi, the French conglomerate. This is great news, isn't it?
Love this deal. Makes very good sense for Activision. It gets rid of that overhang that people have been concerned about for so long, wondering what's going to happen to these Vivendi shares. Are we going to see a flood into the market one day? It's also, they're buying the shares at a discount. Great use of capital.
Sure.
Activision has a wonderfully strong balance sheet. They can afford to put some debt on, use a little bit of cash. They'll come out of this still with a strong balance sheet and remove the overhang. Win-win. Great job.
If you are Sony, if you are Electronic Arts, are you nervous? Are you indifferent to this deal? What do you think?
I think probably indifferent because Activision's been crushing them for years as it is. I mean, Activision has the best games around. It's the best run video game company, and now they're even in a stronger position than they were before.
So the shares pop. That's great if you're a shareholder.
As we are.
As you are in a $1 million portfolio. Yes. If you're not a shareholder, is it too late to buy?
As of now, we have it on hold. Anything at $15 and above, we've traditionally moved the stock to hold. So I don't think this changes anything from an operating perspective. So I think if you own it, hang on. If you don't own it,
wait for a pullback.
Wait for a pullback.
All right, let's get to some of the day's movers and shakers. Starbucks' third quarter profit rose 25%, shares hitting a new all-time high, and looks like food is actually starting to pay off for Starbucks.
I would have never expected these kind of numbers out of a company as big as Starbucks with 19,000 stores worldwide to do 9% comps. Just a fantastic quarter. I don't think you can count on this every quarter, but the future's certainly bright for them. They're doing very well.
Expedia hitting a 52-week low after second quarter profits came in much lower than expected. That is the wiping away of $2 billion worth of market cap I mentioned at the top.
Not a good day. Companies really struggling. It's a competitive world out there, Priceline and Orbitz. Interestingly, the company that they spun off, TripAdvisor, just kind of retooled their site. So the pop-up ads that have referred people in the past to Expedia are no longer doing so in quite the same way. And that's actually taken a big chunk out of their traffic.
Zynga's second quarter revenue dropped 31%, and the company said it will not be getting into online gambling. Now what? I mean, wasn't that the thesis for this stock once upon a time?
It had been for the past few months, Chris. I think they decided the regulations were just too high, which puts them back on their really broken free-to-play model. Keyword being free, and when you're a money-losing business, you got to do something besides that. They have a new CEO came in earlier this month. We'll see if they change directions. And
finally, Deckers Outdoor falling on disappointing second quarter results. The maker of UGG boots also got a downgrade from Credit Suisse.
UGG is the appropriate sound.
I was going to ask if it's time to buy.
Not yet. This is actually the sixth consecutive quarter that results have been weak, both in UGGs and Teva. I need to see a little bit of a correction, a little bit of firming up before it gets interesting. Stock doesn't look cheap enough to me.
All right, that is going to do it for this week. Let's look ahead to next week. Charly, what's the stock you've got on your radar?
Looking at Coach, Chris, they report on Tuesday. What I like about Coach is how well they are doing in the Asian market. Historically, United States and Japan have been their core markets, and they're just now moving into Asia. China's been doing gangbusters for them. I want to see if they keep that momentum.
That's interesting because we've seen this earnings season, a bunch of companies come out and talk about how the economy in China is really hurting them. You think Coach might be immune to that?
And they might be, because we're seeing the numbers out of other fashion companies that are very strong, and I expect them to follow that trend and not the larger macro picture.
Okay. Ron, what about you?
I like UGG. Speaking of UGGs, I like Crocs very much, the shoe company that makes those funny-looking sandals. The stock got crushed yesterday, about 20%. I think that's overdone. There's a lot of concerns about some gross margin issues. I think they're temporary. I think this is a great time for investors to swoop in and pick up the stock on the cheap.
Pick up shares of the funny-looking sandal company?
There you go.
I'm sure they'll love you for that. All right, for Ron Gross and Charly Travers, I'm Chris Hill. Thanks for watching. We'll see you next week.
People on the show may have interest in the stocks they talk about, and the Motley Fool may have formal